In a rapidly changing economic landscape, how prepared are you for the looming financial shifts?
Join renowned analysts Mark Zandi, Gary Wagner, and George Gammon as they dissect potential crises ahead.
With our AI-powered summaries, we've distilled their insights into concise, actionable takeaways, saving you valuable time.
Buckle up as we explore the crucial factors shaping our financial future.
Today, we're discussing George Gammon's insights on an alarming prediction from the Apollo Group regarding the looming economic crisis by June 2025.
According to George, the Apollo Group forecasts both a supply shock and a demand shock, potentially leading to significant economic challenges.
George Gammon outlines Apollo's stark warning: stores could face empty shelves, reminiscent of early 2020.
He explains that the report indicates supply disruptions could drastically affect inventory levels.
What specifics does George provide about the expected supply shock?
George mentions that the Apollo Group predicts significant supply issues leading to widespread shortages.
How do consumers are expected to react according to George's analysis?
George notes that consumers may replicate past behaviors under similar crises, leading to noticeable anxiety around spending.
What long-term economic outlook does George mention?
George cites the risk of stagflation resulting from increasing prices amidst economic slowdown.
What does George predict about potential outcomes from Apollo's analysis?
George anticipates significant bankruptcies in the small business sector due to sustained economic pressures.
George concludes that if these predictions hold true, individuals might need to adjust their financial strategies.
He suggests closely observing economic indicators and preparing for possible financial impacts in the upcoming years.
In today's discussion, we address a troubling report from the Wall Street Journal about collapsing homebuyer demand across America.
According to the report, home sales dropped 5.9% in March, marking the largest decline since 2022.
The Wall Street Journal suggests that homebuyer demand is faltering, primarily due to exorbitant home prices.
In a survey, 72% of respondents cited high prices as the leading factor affecting their willingness to purchase homes.
Data shows increasing buyer fatigue regarding escalating home prices.
Poll results indicate many potential buyers are reluctant to enter the market due to high prices.
We explain the bid-ask spread and its role in the current housing dynamics.
The hosts highlight that significant price adjustments are necessary to reignite buyer interest.
In Florida, for example, substantial price cuts are being made to attract buyers amid decreased demand.
Other markets, such as Georgia, Colorado, and California, exhibit similar downward trends in home values.
With ongoing low buyer demand, continued price declines are expected across multiple markets.
Sellers are urged to adjust their pricing strategies to revive market interest.
In summary, sellers should reconsider their pricing strategies in light of changing market dynamics.
As for buyers, staying informed and exercising patience is key as the market continues to undergo changes.
Today, we're examining Treasury Secretary Scott Bessent's analysis of the current economic landscape and pressures facing consumers, as highlighted by recent market indicators.
Scott Bessent emphasizes that the low yields on two-year Treasury bonds signal the need for the Federal Reserve to consider emergency rate cuts.
Bessent argues that the current low yields indicate consumers are struggling and that the Federal Reserve's responses so far have not aligned with economic realities.
He points out that McDonald's recorded its worst sales figures since the pandemic, highlighting the breadth of consumer distress. Scott Bessent's comments on McDonald's illustrate broader consumer concerns, as their CEO mentioned that geopolitical tensions added to the economic uncertainty.
This decline signifies a worrying trend, with spending from low-income consumers down nearly double digits from previous levels. Bessent argues that the two-year Treasury yield falling below the federal funds rate is a clear market signal for necessary adjustments.
He highlights that these adjustments should be seen as necessary responses rather than simple stimulus measures. Bessent explains that the bond market reflects not just U.S. economic challenges, but also wider global issues concerning demand.
This interconnectedness suggests that strategic adjustments across markets may be essential to manage the impending economic shift. Bessent's insights suggest that if trends continue, the Federal Reserve will need to cut rates to respond to worsening conditions.
Market reactions corroborate this view. as the bond market's movements indicate a clear expectation of this adjustment.
Besant suggests that retailers and businesses should align their strategies with the changing economic landscape.
For investors, adjusting to potential rate cuts could be crucial for preserving gains and navigating market volatility.
Today's video focuses on housing market analysis, featuring Mitch Wexler.
Mitch challenges the narrative that we need 4 million more homes, given there are ample vacant properties.
Mitch highlights that the narrative of a housing shortage is misleading due to the high vacancy rates.
He explains that the need for more listings often distracts from deeper systemic issues like economic manipulation.
Mitch questions the need for more homes in light of the large number of vacant houses.
He addresses how realtors are misled by these persistent narratives.
Mitch argues the Federal Reserve's monetary policies have led to inflated housing prices.
He illustrates how increasing debt-to-income ratios have made homes unaffordable for the average American.
Mitch explains how many American families are facing homelessness as rents rise.
He warns against misleading financial advice that can trap buyers.
Mitch predicts a continued rise in homelessness if current trends persist.
He calls for reforms to address the core issues driving the housing crisis.
Mitch urges viewers to critically examine prevailing real estate narratives.
He emphasizes the importance of education and community engagement in navigating the housing market.
Today, we're discussing Mark Zandi's insights on the looming economic challenges as articulated in his conversation with David Lynn.
Mark Zandi predicts significant headwinds for the U.S. economy and markets in the near future due to ongoing trade tensions.
Mark Zandi identifies the chances of a global recession as exceeding 50%, a stark warning for investors and policymakers alike.
He emphasizes that current market valuations fail to reflect the probability of a serious downturn.
What does Mark Zandi say about the effect of tariff policies?
Zandi notes that tariffs are impacting supply chains and trade stability, potentially hindering economic growth.
Which sectors does Zandi believe will suffer most during an economic downturn?
Zandi highlights manufacturing and agricultural sectors as being on the front lines of this economic strain.
What is Mark Zandi's perspective on the valuation of equity markets?
Zandi argues the market may be overvalued and not adequately prepared for a potential downturn.
What market corrections does Zandi foresee?
He warns of substantial corrections in equity markets if the recession materializes, estimating declines of 10 to 30%.
What actions does Zandi recommend for policymakers?
Mark Zandi emphasizes the importance of decisive policy measures to stabilize the economy and clarify market expectations.
Today, we explore insights from Gary Wagner on the gold market, delving into the recent signals from his technical analysis.
Gary highlights the correlation between gold's price movements and various macroeconomic factors, offering a perspective on the market's future.
Gary Wagner discusses the impact of a weakening U.S. dollar on gold prices, noting that each percentage drop in the dollar contributes directly to a corresponding increase in gold value.
He emphasizes that a 9% decline in the dollar this year translates to a similar rise in gold prices, showcasing the intricate dynamics at play. Gary mentions that gold recently reached historic highs and discusses the importance of the price movements leading to these levels.
He explains how the recent rally has been characterized by strong price gains and consolidation activities. Gary indicates that market sentiment plays a crucial role in gold pricing, especially in times of uncertainty.
He notes that buyers have been active, which has helped sustain gold prices despite market fluctuations. Looking forward, Gary predicts that gold should establish a consolidation base around $3,300, suggesting more momentum can follow.
He sets potential targets for gold prices at around $3,600, highlighting strong fundamentals supporting this movement.
Gary anticipates that gold prices will likely increase as macroeconomic factors such as tariffs and geopolitical risks continue to unfold.
He stresses that with the current state of the economy, gold could see substantial increases moving forward.
In conclusion, Gary advises investors to pay close attention to economic indicators as they relate to gold investments.
He suggests that given the current market situation, there may be opportunities to buy the dips as gold remains a sound investment strategy.
Wow, what a roller coaster of insights from our financial experts today.
Absolutely. Each guest, from Gary Wagner to George Gammon, contributed some compelling thoughts.
It's clear they all agree that we're in a challenging economic landscape that requires careful attention.
But the real conversation starter was the timing of a potential recession. Zandi says it's imminent, while Gammon pushes it to mid-2025.
And let's not forget Mitch Wexler, who highlighted the crucial issue of affordability over mere housing inventory.
Right. He directly contradicts Besant, who looks at indicators of declining consumer confidence and spending. It's a tangled web of challenges.
If this conversation sparked your interest, don't forget to like and subscribe so you don't miss our next deep dive.
Exactly. Your support makes it possible for us to bring these valuable discussions to you every week.
Stay tuned for our upcoming video exploring market dynamics and their implications.
You won't want to miss it, and we can't wait to share more insights with you.